Okay, hello everyone. Welcome to this week's weekly study session, June 8, 2024. Just a recap from last week, we spoke about the FOMC minutes, noting that the readings were somewhat disappointing with inflation, and that was leading to a higher than longer narrative in the market. Of course, the market's held up relatively well, but we just had the May employment report, and it rose more than expected, and Powell has recently said that he looks for more than just one report before he would conclude that that's a meaningful change and to uh, change interest rates as a result. The employment rate, however, moved up a little bit to 4%. That's been inching up, and that's actually a good thing. Mild weakness right now is considered positive. The inflation correlated unit, I'm sorry, I'm getting tongue-tied there, unit labor cost, which represents about 70% of corporate costs, rose about just under 1%, and that was lower than projections. So sort of a mixed picture, but certainly the labor market is something that the Fed is focusing on, and I think this most recent report is definitely putting the hands tied of the Fed for lowering interest rates. When we take a look at something like the weekly leading index, the ECRI, if you look at the LEI, that's come off quite a bit. And usually that leads to a recession. But with that, you would think that we'd be looking at lower interest rates in the future, but the probabilities right now are almost zero that we're going to see any type of lowering of rates anytime soon. And of course, I've been keying in on the 1 year as my canary in the coal mine, and we started rolling over a bit, but as of Friday, of course, rallied and just moving sideways, sort of in a basing fashion here. And I think this is sort of what we need to key in on if we want to get an idea of the direction that we're seeing here with potential interest rates. With the Fed, I think you're going to see it led by the 1 year, and a breakout to the upside would be, I think, negative for the market. And if we break down to the downside, I think that would be seen as positive as long as it's not accompanied by some real weakness in the economy. And then you're going to see a shift over to recession fears. So that's a bridge that we haven't crossed yet. But certainly we've seen uh, the uh, the forecast for the curve of rates with regard to the Fed funds and the shorter term rates. When we entered into 2024, we're looking at those coming down into the threes by the end of 2024, and now all the way up to almost 5% as of last month. And I think my feeling is right now, as opposed to pricing in 1 to 2 cuts, I think it's a zero to maybe one cut by the end of the year with what I'm seeing so far. Now, good news is, and I think one of the reasons the market's holding up and things are holding up relatively well, although a mixed picture. Certainly, the market overall, the indexes have held up, and that is that we are in that Goldilocks environment where we're not too hot, not too cold, and that's where I pointed this out many times. If you looking longer term, if you go back pre the 1980s, or certainly up until the Reagan era, we had wide swings in the GDP, we had wide swings in the economy, and that led to a lot of volatility in the market and a sideways action or long term sideways action where the market didn't make much progress for decades. And then when we entered into the 80s, we started getting those calmer periods, and then of course we would roll over into recession, but they would not lead to big inflation spikes. And even this most recent inflation spike, you can see that was related to the COVID situation. And I know, the term transitory was used, and it's been years, so it's certainly not as transitory as as most thought. But then again, that big spike isn't something that we've sustained in the GDP, and the forecasts going forward are for about 2.5 to 1.6% over the next year, and that's right within that range. That would be a nice range for the market. Looking at the cycle composite, again, this is looking at the bullish side of the equation. We do have an upward bias there, and that's also backed up by the 4 year presidential cycle. Of course, if you remember, I was looking for a potential rate cut to happen mid-year if the data supported, and then we would have gotten a positive cycle environment. We would have gotten the presidential environment cycle over the 12 months from the mid 2024 period into the mid 2025, and then with a non-recessionary rate cut, you get all kinds of convergences of a positive tailwind for the market. Now that still may happen, but it might be delayed. But there are some tailwinds there as far as seasonality is concerned, whether we get that rate cut and we get that environment. And who's to say that the market hasn't discounted a lot when we get a rate cut and the market rolls over? Certainly, we've seen the historic types of correlations be out of whack since COVID. So I wouldn't put that out of the realm of possibility either. The market is, when you look at traditional valuation based on interest rates, is about fully valued right now. But however, in bull markets, you can get very overvalued. If you go back to 2000, we got way overvalued and stayed there for a long time. When you look at what's been going on here in the market, there's still where you have a concentration since the end of 2022. The technology and communication services are up about 90%, and they're the only sectors besides a small gain for discretionary to outperform the S&P 500. So there's this big disparity here, and if you take a look at the sort of the layout of the areas that have done well, energy is the one that has done the worst. So some are pointing out that there's this big disparity between technology and energy and physical products, if you will, energy materials and so forth. And if you take a look, you can see how we're edging up on the technology sector to those areas that we were at in 2000. We had that big top, and inversely to the other sectors. So again, I think this could persist though for quite a while. This isn't something that has to turn on a dime at this point. But what is concerning me is when you take a look at the recent move in the S&P 500 in May, it was driven by technology, mainly the Magnificent Seven. Of course, if you take Tesla out, they all saw positive returns, and those 7 stocks contribute over 60% of the index's overall return, and that's gone to a new record concentration. If you look at the technology weight in the index, it's up around 30, almost 31%. That's the highest level since 2000. So we're absolutely concentrated, and it's actually getting more and more concentrated. And the one thing that's concerns me, at least for maybe some type of pullback, or certainly to make an environment that is a selective environment, a difficult environment to navigate, would be that right now, again, the 200-day moving average, the 50-day moving average, the percentage of stocks that are above those respective moving averages, particularly in the NASDAQ, if you take a look, and let me just bring that chart up, you'll see that we're getting that divergence again, 42% above, while the NASDAQ is way above the 200-day moving average. We only have 42% of stocks above their 200-day moving average. So that right there shows that there's a narrowing of the participation, and whenever we get in this situation, we usually get a pullback, and that's being confirmed now with the 50-day moving average. We're well above the 50-day moving average, and we only have about 38% to 39% of stocks above their 50-day. So this is really the air is getting thin up here. So I think we got to be, again, cautious about not just a pullback in the indexes, but an environment that is highly rotational and is difficult to navigate. When you take a look, this would make sense too, because we still have that looming potential volatility. We haven't seen a 100% or 150% rise in the VIX in quite some time. As a matter of fact, 150% rise. We're now at the second longest that we've been since we have 150% rise in volatility going back to the 2000 period. And then again, of course, the 100% rise is about the fourth longest, and volatility has been very low, which is great. I mean, that's what we want to see. We want that lockout rally. But there's been pockets of volatility with the individual stocks. That's looking at the index, at the S&P 500. I'm gonna talk about that volatility in just a minute with the individual stocks. But first, let's just look at the key components. We upgraded major indexes to positive. You really just can't deny they're hitting new highs. They're acting quite well. Certainly the S&P 500, the Nasdaq. When you get into the the Russell 2000 and the 400, the mid caps, yes, they're still lagging, but that's the same story. Up, down volume, new highs hasn't changed. We're neutral on that. Individual stock participation, we did move up to neutral, and that we moved the stem model from hard penny. I very briefly I moved it to hard penny. It looked like we were going to run into some trouble on the individual stocks, but we do have it's a mixed bag. We have some that are working, but some are not working well at all. And like I said, I'm going to talk about that in just a second. But when you look at the advisor models, if you're in the S&P 500, you want to stay long at this point. We're 100%. Buy signals are still in force. This is a very long-term indicator. I just want to take a moment real quick to show you, maybe zoom up on it a little bit here, and you can see that buy signal happened back here on January 13th. And since then, the way it works, the 33 will ladder itself down. Once it goes to 100%, that's 100% invested, you get a buy signal, and then you'll ladder. So if it comes off to 66%, you would raise 33% cash. It came down here to 33% briefly, didn't go to an outright sell signal, but you would ladder with that. And then as it goes back up, you would ladder back in. So you would go down to 33% cash, 33% invested, I'm sorry, and then move right back up to that 100% invested. Same thing with the 25. The only difference with the 25 is that when it comes down, it doesn't go to a sell signal or 100% cash at 0. It goes at 25. So once it goes on a buy signal, which is 75%. When it hits 75%, it goes to a buy signal, which is 100% allocation. When it rolls over, it'll ladder down. So you'll go from 100% to 75 to 50. But then when it goes to 25, you don't go to 25% invested. 75% cash, you go to 100% cash. So that's something that you'll see sometimes will ladder you out a little bit earlier because it moves in quarter increments as opposed to third increments. So you take a look at the stem. As I said, we move this up, and I mean, I could very easily make a case that it's hard penny. I can also make a case that it's cautious orange. I cannot make a case for green. I cannot make a case for easy dollar because there's just too many pockets of air, too many air pockets for me to say that this is an easy dollar environment. And like I said, I'll go over that in a minute. I want to show you what things that are happening that don't happen too often in an easy dollar environment are happening too often right now. But real quick, just looking at the mid cap, because as you know, I was looking for the mid cap in the Russell 2000 to hold and hold these recent breakouts to where they don't completely fall apart. They can underperform, and they are underperforming. You can see the relative strength line, moving to lows here, and we're getting a little heavy there. You can see a little ledgy looking on that right side. Same thing if you look at the Russell 2000, but longer term. We're working on those big bases, and we just don't have the interest rate environment yet, which is going to make that shift. And I think the big thing that we'll get when we get an environment where maybe rates have to come down is you're probably going to get at that point a shift out of the mega caps. And I don't know if they'll discount it ahead of time or not. So far, they're not really doing that. But certainly, that's something that you could get that shift and could be the catalyst to have these small and mid caps start to maybe outperform at that point. But what I really want to focus on and continue to focus on is the individual stocks, but the proxy for that would be the IBD 50. You can see we broke out of this base that we formed between February and May, June, and now just pulling back here. And this is where if this could, continue up here and come back up from that natural reaction, we get some tennis ball action, you're probably going to see that in the individual stocks. Same thing with the IBD 8585, which didn't really break out. It just poked its head out there a couple weeks back, and this is one where you want to see this break out, and you can see the relative strength. We're not outperforming, so this is where you want to see that shift. But right now, take a look at something like Land's End. Now, this went into earnings, so you're going to have volatility around earnings, but this is a big crack in the block here, right? You got a power play setting up, and then whammo, it gets hit. But you know what? We're seeing that in other areas too, right? BSTG just had this one where it came out of a tight little pivot. Everything was looking good. If you remember, I've been posting, be careful for those squats, those reversals, and that's precisely what's happening here. That's a huge outside day, a lot of volatility. If you remember, if we go back, you can look at FIHL, that same thing, right? We broke out and then whammo, come in, that big volatility. Take a look at MSGE, Madison Square Garden Entertainment. There was another one that broke out of that little base a few days later. Boom, big giant volatility. Again, some of these, some areas have been around volatility, but I'm sorry, around earnings, and we get that volatility. But still, this is too many. We're seeing too many stocks with this big volatility. STTK, another one. You broke out, you pulled back. It looked like it was potential natural reaction. Started turning up, and then whammo, the big outside day. And this is just not the action of an easy dollar environment. Even recently, we had Autoliv, which was holding up quite nicely, and then whammo, gets hit below the 50-day, just going from looking completely natural to totally unnatural. And just, of course, the Thursday and Friday, we had Apollo, try to move up here. It looked like we were getting a reversal recovery, but it reversed right where it reversed before, and just not getting that follow through. Now, there are some areas that are working. They are holding up, and we have a number of those that we've been holding. Oh, by the way, GoDaddy got added to the S&P 500, so that's going to pop. We sold that too early. There's a few names that we've had that are getting added to the S&P 500. Real quick, before I go into some stocks and summary, it's a selective market for sure, and the headwinds are inflation and rates and sentiment. Sentiment has still remained at complacent levels, or I should say even more than complacent levels, semi-frothy levels, not super frothy, but frothy enough where we could use maybe a little bit of pullback. I haven't seen the put volume go up though. As a matter of fact, the put volume numbers have improved, so that's good. So maybe we can keep inching along here on the indexes, but certainly with the recent economic report, inflation and the rates are still an issue. And at a fully valued market, it's definitely going to temper things overall. Tailwinds are seasonality and a Goldilocks economy where we're not crashing into recession and we're not having this hyperinflation. So we're in a sort of a perfect spot there to keep things moving along. But again, how do you cut through all this nonsense? Stocks, the individual stocks. And what we're seeing now, some are working, some are not. There's high volatility in the areas that aren't working. So what do? You have to cut that volatility off, and you need to actually tighten up, right? Don't let the stocks, don't play the volatility game. Cut that volatility off, because now you're going to have wider you're gonna have wider volatility. You're gonna have your stops. Some of them are gonna blow through. You're gonna have a lower batting average. So you have to make up for that, and that's by tightening up the stops and being more selective in your choices. Let's take a look here. And I'm going to go over just some stocks here. I haven't done a full screening yet, but AVGO, the semis, I added some semis last week, the AMAT, KLAC, a bunch of them. You could even look at the SOX or the SMH as indexes, but AVGO, Broadcom, I'm looking at as a potential. I'd like to see it build out a right side here and then come out from there. That would be great. One of the areas that I like at this point, and that's a particular stock that I like the fundamentals on. BKNG, trying to put in a base here. It moved up from that little pullback buy, but pausing really perfectly right at the right spot that it should. We'll see though, because some of these look like they're normal, and that's just before the shit hits the fan. Domino's putting in a little base here, maybe a pullback buy from there. This INSM has some really good phase 3 trial results. This is short, of course, and you're probably saying, what's he doing with this very short 5 or 6 day quote unquote base? I thought it might just go and continue from here. Sometimes when there's really good news and you get a big move like this, it keeps going, and you don't get that power play flag, if you will, until it goes up, 300%, 400% sometimes. So just trying to, if in case it continued, I went in there and bought some, but with a really tight stop. And now I'm looking for this to hopefully put in a base here and give us a really good a buy point, certainly for those of you who may not be involved in it yet. KSPI trying to form a right side here. MU, I went to overweight. I mean, it's acting fine, and this is one where fundamentally, I think it could be much higher. Technically, it's acting great. It had that pullback, and this is where it really needs to hold here. And what I did is I moved the stop up and just backstopping the whole position now. I'll watch it carefully for the overweight if I want to take that off if it starts acting abnormal. NXT is another one. This right side, it's a little compressed, but this is one I've been watching for a while. You had that IPO base trying to form over here. There's a lot of volatility, and it could never really give a real a crisp entry. I'm hoping we get a better entry here when we get a better right side building. WDC is another one that could, hopefully it holds here. You got this little natural reaction. It's a little volatile here, a little bit, there's a lot of reversals here. So we'll see if it succumbs to the type of action that we've seen in some of these other names that have given us pivot problems. Like I said, AMAT, you can take a look at the various semis. AMRX, another one. This is one that you guys put in the symbol drop box last week. It's a small, a lower price, but it's trying to form some tightness right there. Now, of course, we saw some weakness in coin. Coin ran up. Things were looking pretty good. But when Bitcoin itself, IBIT, couldn't really move much, I had a feeling we may still need some time to build this right side. This obviously is not what you want to see, this down day that was fairly large, but this is still perfectly fine. It can build a right side here. And quite frankly, I prefer it to build a right side and take some time. I mean, if this could hold up, even maybe if it undercuts for a day, and you form a better right side, I mean, this would be great if we could get something like this. It would be picture perfect for a VCP. So maybe too obvious, I don't know, but you'd be surprised how good these sometimes set up. Think everybody sees them, but they don't. So watching that and coin to see if they can improve. This IHG, of course, tried to play it off a bottom fishing type pivot, got shaken out. This is resetting here. With the 50-day and a downtrend at that time, it's not a surprise that you got to shake out. Maybe this can set up, give the 50-day a little time to flatten out here. That you would have gotten a minor angle warning if you ran monolith on that, which would have kept you maybe position sizing lower than normal. Let's see what else. Lily's acting really good. I de-risked it, of course, and now we're fully financed to stop. ML came out real nice here, pulled back. It's now 1, 2, 3, 4, 5. It is 6. Wait, is it 1, 2, 3, 4? Yeah, 5 lower lows. So I was hoping after that third or fourth lower low, we were going to see it bounce there and give us a nice pullback buy there. But you had that outside day. It's a little excessive now. So I would say it's starting to act a tiny bit abnormal. But I would watch this to see if this sets up and you get a pullback buy. ONTO, a leader that I think we could look at for a sort of a cap pattern here, forming this right side. Look for some type of pivot to form there. PINS is acting really well. I went into that. This is one that just in my mental library, I've seen this type of action before, and I like the precedent. And you had that big move on earnings, wedged back a bit here. So a lot of these I'm taking from very low risk entries. RCL's acting really good. Right now I wouldn't say buy it here, but keep an eye on that one. Let's see, SKWD. This needs more time. It needs more time to set up on this right side, and I'd like to see it set up closer to these highs. If it could tighten up there and then from there clear those highs, it would be a better buy at a higher price. And that's something that those of you that haven't been with us for a while need to understand and learn about. TTD, again, from the pullback buy, acting normal. Now we get hit, boom, little tiny increase in volume. It's still acting normal. It's still okay, but but a bunch of these went from looking normal to abnormal pretty quickly. So you got to stay on your toes here. UCTT, again, trying to tighten up on the right side. Amazon, was underperforming. I thought it was going to maybe give us a pullback buy here. It came off, coming back. At this point, yeah, you probably I put FNGS on the focus list. It's probably might be the best way to play the FANG area or the Magnificent Seven. Let's see. This COKE is acting really good. Had that big gap, little base there forming. Just trying to go through my list here. Yeah, I still haven't done my full screening, but that's sort of a quick run through. And some of the stocks that have been lingering on my list, but I don't expect to get aggressive until I see the list expand and I see better action coming from the breakouts, and we need to see less of that volatility and those big breaks. When the market's really under accumulation, institutions are really stepping up to the plate. You don't tend to see much of that. It's once in a while, but it's not something where you go buy 8 or 9 or 10 stocks and 5 of them implode. That's not your best environment. So I think once again, orange is probably the right reading right now, and it could very easily go to red if things shift, and it'll take maybe a little bit to go to green, but we see these things change very fast. I mean, you can go from having a market that looks horrible to, and there's just no stocks anywhere, to all of a sudden the focus list, there's 40 names and stocks are breaking out all over the place. And that's why you got to just keep your finger on the pulse day by day and bend with the evidence of the market, and don't get too caught up in an opinion. All right, I covered a lot. I'm out of breath here. These are all off the top of my head. They're unscripted, so I'm just rattling on it. So I hope it's been helpful. And I'll see you guys on Monday. This is actually Saturday. I'm doing this earlier, traveling this weekend. And then I'll see you on Monday at 11:30 a.m. Eastern Time for live Q&A with myself, Mark Ritchie, Bob Weissman as the moderator. And I hope you have a good rest of the weekend. All right, bye-bye.